Hey, what is up everyone? It's David here. Market corrections are inevitable. It's not literally like stocks up and to the right forever. Plus, it's perfectly healthy to experience a market correction in the near future because it gives room for young investors like me to buy in at a much cheaper price. So in this video, I want to talk about a few things I've already taken action on to prepare for a potential market correction, and an update on the big changes I've made to my portfolio. As usual, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. So, without further ado, let's go! Okay, first, my plan to capitalize on the future market correction is really broken into three main steps: preparation, identifying opportunities, and execution. The idea here is to treat myself like a business. And the first step is all about preparing myself to be able to capitalize on the market correction. That means reducing my expenses where necessary to allow for more cash flow, taking a bit more client work to boost my cash flow, and studying market structural tailwinds that will grow my wealth exponentially in the future. Reducing expenses is where you see fit, and client work is more like a side hustle for me now. And studying the market structural tailwinds means listening to more podcasts, reading more reports, and just generally paying attention to technologies that are going to substantially decrease the cost to something critical to our lives in the future. A great place to start is Invest Like the Best podcasts, Big Ideas Report from ARK Invest, or even look at sector allocation reports on all 13F filers in whalewisdom.com. All of those resources will give you leading indicators on where the structural tailwinds are happening. And Hacker News from Y Combinator is possibly one of the more bleeding edge informations that you could possibly read. It's also a really good idea to define the investor you want to be. What kind of time horizon do you want to invest in? What kind of returns are you looking for? And the type of companies that are an absolute no-go for you. So for example, I have a time horizon of about 5 years, and during this period, if I'm individually selecting a company, I'm looking for a 2x to 5x return over that period. And the type of companies that are a no-go for me are fossil fuel companies, defense companies, and potentially gambling companies. Then once I've identified structural tailwinds that will add a lot of value to our world in the future, I'll dig deeper and create a watch list that if a correction happens, I'm going to hunting mode and I'm going straight for it. When a correction is happening, I don't want to be thinking. I just want to be taking action. So during the second step of my plan, I'm going through company reports, interviews, and putting all of the companies I'm interested in into a watch list on TradingView so that I can monitor the prices. If you want to see how I've created my renewable stocks ASX watch list, check out my video in the description box below. The final step is all about emotionless action. Because I've done all the work in the first two steps, I've already taken some action, so I'll be sharing a portfolio update in just a second. Let me quickly summarize. During the preparation and identifying opportunities phase, this is where I make sure my expenses are minimal, finding new ways to earn more cash flow, and preparing a list of companies I want to invest in if a market correction do show up. Then once a market correction do show up, it's about minimal thinking and maximum action. So let's go through a portfolio update, and then I'm going to show you some of the big changes I've made into my portfolio. Now for my CMC market portfolio side of things, it's now worth 79,000 Australian dollars. And I've contributed another $4,000 into Asia ETF. And I've also exited my ResMed position completely in order to add more into Asia. Now the reason for adding Asia into my portfolio is documented pretty extensively in my 3 high growth ETF video. So I'll leave a link in the description box below as well. Now besides that, I haven't made too many changes on this side of the portfolio. It's pretty much the same, but the big changes are on the stake side. So let me take you over to my stake portfolio. So my stake portfolio is worth about 41,000 US dollars, including the buying power, which is approximately 53,000 Australian dollars. The big changes I've made here is that I have exited my ARK W position, my T. Rowe Price position, and also my BlackRock position. In my investment style changes video, I've documented that I want stake to be a place where I really go for it. And because of that, I've added HIMS, I've added Mercado Libre, and I've also added OZON. I didn't make changes anywhere else. Everywhere else is still exactly the same. So let's go over the reasons why I've decided to add these companies into my portfolio. So the first company is Hims and Hers. And this is a digital health platform in the US providing consultations with doctors and personalized treatments for individuals. Now, I actually had the opportunity to work on a competing platform here in Australia that's funded by venture capitalists. So I already know a lot about the industry. And when Hims and Hers went through a SPAC, I honestly couldn't resist. So let's talk about it. Now, the healthcare opportunity is massive. And if you compare the healthcare opportunity of $4 trillion to financial services of $1.5 trillion, it makes financial services look like a little brother. And if we zoom into the healthcare opportunity, given the situation of the pandemic, it accelerated the need for healthcare to be delivered remotely versus visiting a doctor. Not to mention, each age group's total addressable market is ginormous. Not to mention, it is constantly growing. The current process for healthcare is pretty expensive, especially for the US. Not to mention that if you're in a rural county, it's even harder to access the healthcare that you need. And then you have to schedule in a time that will interrupt your work schedule in order to go see those doctors. Overall, it's just pretty damn inconvenient. The solution for Hims and Hers is to provide a digital healthcare platform so that you can book and do your consultation with doctors at your own time and online, not to mention get personalized treatments delivered to your doorstep with discreet packaging. Their current solution spans across both men and women. For men, it could be hair loss and ED. For women, it could be both hair loss and also contraception. Not to mention that there is plenty of future opportunities in sleep, fertility, diabetes, and cholesterol. Okay, cool story. What about their traction so far? Now, since 2018, they have grown 128% in revenue compounded annually, with a 71% gross margin and a 3x LTV to CAC. With this kind of gross margin, it feels more like a software business than a healthcare business. If you look at their cohort of customers, you can see that the most recent cohorts are really leaning into the idea of digital healthcare, with their cumulative revenue per new subscriber really shooting up in much shorter timeframes. And because of the significant tailwind of the pandemic, the customer acquisition costs, especially during this peak period of the pandemic, have substantially decreased. And I personally believe that once their customers have tried the service, it will significantly reduce the probability of them churning. And that over the long term should keep the customer acquisition costs relatively low. And over the next 2 years, Hims and Hers is forecasting their revenue growth to be at 30% year on year. And I think they're lowballing here to manage expectations. I believe that the flood of customers during 2020 is more than likely going to stay, giving the company a lot of opportunities to cross-sell different products into those customers. And at the same time, if Hims and Hers can continue delivering a great customer experience, I think the inherent word of mouth will spread like fire. Now, because Hims is mostly a digital business, let's take a look at the SEO data as well. Now, as you can see, for hims.com is their main domain, and they generate approximately 1.1 million sessions per month. This is a per month basis, and their organic traffic growth looks really good. It's not as good as Get Romans. Now, Get Roman is purely for men, and it's one of Hims and Hers major competitors in the US. And as you can see, they bring in 1.37 million sessions per month. And the last thing I want to point out here is that if you look at the branded searches versus non-branded searches for Hims, a big percentage of the searches going into Hims is actually non-branded, which means that there are a lot of opportunities to drive new customer acquisition. If you've also been following me, one of the reasons why I place a heavy emphasis on SEO, especially for digital businesses, is that SEO tends to reduce your customer acquisition costs over time, because once you build up that traffic, if you've done it right, are here to stay with you. And Hims and Hers is still a co-founder-led business. Andrew owns more than 9% of the company after it went public, and the rest of the team have incredible, relevant healthcare, technology, and consumer experiences. Ultimately, the space is incredibly competitive, not just with public companies, but also with private companies. But the market size, unit economics, and the fact that it's a co-founder-led team convinced me that this could be one of the opportunities that will exponentially grow my wealth in the future. Okay, the next one I added to my portfolio could be an absolutely idiotic move or a great one. If it's idiotic, I'll be the first one to admit, and you guys can absolutely wreck me for it, but let me explain why I added OZON to my portfolio. OZON is a Russian multi-category e-commerce marketplace, very similar to Amazon. The opportunity here is that Russia have one of the largest internet audience in EU with a high percentage of internet penetration, but the e-commerce penetration is just incredibly low at 6%. And as e-commerce penetration get up to the level of neighboring countries over the next 5 years to 16.5%, it's anticipated that the Russian e-com market size will be 7.6 trillion rubles, which is about 95 billion US dollars. Okay, cool. How will OZON win market share? The largest e-commerce company in Russia is Wildberries. It might be a bit hard to see, but it's this pink logo right here. But one of the biggest challenges with e-commerce in Russia is logistics, because the country is literally massive. Having one of the biggest pickup infrastructure in Russia definitely helps, not to mention being the most recognized brand with the largest multi-category assortment. Their team also have a proven track record on execution, where the year-on-year gross merchandise volume have grown by 142% since 2017. The adjusted EBITDA have improved as well, not to mention the fulfillment footprint have increased by close to 4 times. And their team's technical competency is largely driven by the fact that majority of the team actually came from Yandex, which is Russia's largest search engine. Not to mention, the CTO came from Lazada, and Lazada was one of the largest Singaporean multinational e-commerce company now owned by Alibaba. The logistics footprint, the brand, and the team's technical competency have translated into a strong growth in customer base, which had led to a stronger growth in active sellers, ultimately lead to a higher assortment of SKUs. And as long as OZON continue to deliver on a strong buyer experience, this is a very virtuous and powerful network effect. And if we zoom into the customers for a second, you can see that the average number of orders per active buyers are growing substantially since the pandemic. Not to mention, the gross merchandise volume in 2020 is growing incredibly fast on a quarterly basis and also on a year-on-year basis. And that have likely attracted more active sellers as well. And as of recording this video, they have experienced their first quarter of positive operating cash flow. Okay, so why would this be such an idiotic move? They are free cash flow negative and things were not looking good until a blessing in disguise happened in 2020, where the pandemic have, for the first time, pushed people to transact online. And they have issued debt over the quarters to fuel their operations. But it seems like because they're becoming operating cash flow positive, they might not have to issue debt in the near term anymore. At the same time, there are a lot more short-term liabilities than short-term assets, which in this case is known as negative working capital, and that could be viewed very negatively. But the question is it actually a bad thing? Sam Walton, the founder of Walmart, famously leveraged negative working capital, which is short-term liabilities exceeding short-term assets, to generate massive return on equity. You might actually find the same thing in Costco and Amazon as well in its early days, even now to be honest. So let me go through an example with you why negative working capital might not be that big of a deal. So say Walmart wants to buy 500,000 DVDs and the payment terms to the supplier is 30 days. I know DVDs is a bad example, but just bear with me. Now let's say Walmart, because they turn over the inventory very quickly, they have sold that inventory in 20 days. So what this really means is that Walmart doesn't have to carry enough cash to pay off all of its short-term debts, as long as they have enough cash to pay off the supplier on the day when the payment term is due. Because when you have too much cash in your short-term assets, it's not doing anything. So you are lowering the efficiency of deploying your capital. So what I'm trying to say is that having negative working capital is not exactly a bad thing, but negative working capital is only a good thing for a few industries. Like for example, groceries, restaurants, both physical and online retailers, because they can leverage those payment terms to their advantage. And if you want to check if the company is actually utilizing this as part of their strategy, look at their accounts payable, and if that number is massive and their working capital is negative, the company is probably leveraging negative working capital as part of their strategy. And because of the debt and accumulated losses over the years, the company does have a negative shareholder value. And that essentially means that if we were to sell the company today, after all of its debt and liabilities being repaid for, there'll be nothing left for equity shareholders, which is people like me. So why am I interested in the company then? The opportunity in Russia, logistics, infrastructure, order frequency all play a part. But the thing that intrigued me the most and pushed me over the edge is their SEO advantage. Now, if we look at OZON's SEO data with a focus in Russia, we can see that they generate 28.8 million sessions per month. And this organic growth is massive. Not to mention, a big chunk of this traffic is non-branded, which means that there is a lot of room to convert this non-branded traffic into customers. Compare that to Wildberries is generating 16.8 million sessions per month, and more than half of this traffic is branded. That probably means that it's more repeating customers than brand new customers. On that front, OZON generating 12 million more sessions than Wildberries, it's really hard for Wildberries to close that gap in a short amount of time. So what I'm ultimately saying is that despite the work in progress with OZON's fundamentals, the opportunity, the network effect, and the powerful SEO advantage convinced me to take a research position in OZON. And if I'm wrong, we can do a diagnostics video on where I was too overly optimistic with my assumptions. So thank you for watching this video all the way to the end. If you want to support the channel, not to mention access to additional content pieces and be part of my fortnightly Q&A, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, remember to gently smack the like button right there, subscribe to my channel so that when I release future videos, you be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.